A home equity line of credit, or HELOC, can be a useful tool for paying off your mortgage faster, but it requires careful planning and discipline. Here's a detailed explanation of how it works, along with an example to illustrate the process. A home equity line of credit, or HELOC, is a revolving line of credit that allows you to borrow against the equity in your home. Equity is the difference between the current market value of your home and the balance of your mortgage. A HELOC typically has a variable interest rate and functions much like a credit card, where you can borrow, repay, and borrow again within the draw period. The idea behind using a HELOC to pay off your mortgage faster is to utilize the HELOC's lower interest rates, which are typically lower than mortgage rates, and the flexibility of the revolving credit line to make larger or more frequent payments toward your mortgage principal. By doing this, you can reduce the principal faster, which in turn reduces the overall interest you'll pay over the life of the mortgage. The steps involved are pretty straightforward. First, obtain a HELOC. Secure a HELOC based on the equity in your home. For example, if your home is worth $400,000 and you owe $250,000 on your mortgage, you have $150,000 in equity. Depending on your lender's terms, you might be able to get a HELOC for a portion of this equity, say $100,000. Second, use the HELOC to pay down your mortgage principal. Draw funds from the HELOC and use them to make a lump sum payment on your mortgage. This reduces the mortgage balance significantly, which in turn reduces the amount of interest you accrue. Third, make regular HELOC payments. After using the HELOC to pay down your mortgage, you'll need to make payments on the HELOC. The goal is to pay off the HELOC as quickly as possible to minimize the interest paid on it. Since HELOCs often have lower interest rates, you may save money even though you're now paying off two loans. Finally, repeat the process. Once you've paid down the HELOC, you can use it again to make another large payment toward your mortgage principal, repeating the cycle until the mortgage is paid off. Example: using a HELOC to pay off a mortgage faster. Scenario: original mortgage balance, $250,000. Interest rate on mortgage, 4.5%. Remaining term, 25 years. Monthly mortgage payment, $1,390, principal and interest. Home value, $400,000. Available HELOC, $100,000 with a 3.5% interest rate. Step 1. Obtain a HELOC. You obtain a HELOC for $100,000 based on the equity in your home. Step 2. Use the HELOC to pay down the mortgage. You draw $50,000 from the HELOC and make a lump sum payment on your mortgage. This reduces your mortgage balance from $250,000 to $200,000. Step 3. Reduced mortgage payment. After the $50,000 payment, your new mortgage balance is $200,000. If you continue to pay the original $1,390 monthly payment, more of your payment goes toward the principal because the interest portion has decreased. Step 4. Make payments on the HELOC. You start making payments on the $50,000 HELOC balance. Let's assume the HELOC has a 10-year draw period with interest-only payments required during this period. If the interest rate is 3.5%, your monthly interest payment would initially be around $145. However, instead of making just the minimum interest payments, you decide to pay $500 per month towards the HELOC balance, reducing it faster. Step 5. Repeat the process. Once you've paid down the HELOC, say over the next few years, you can borrow from it again to make another lump sum payment on your mortgage. This cycle can be repeated, steadily chipping away at the mortgage balance. Benefits: interest savings. By paying down the mortgage principal faster, you reduce the total interest paid over the life of the mortgage. Flexibility. A HELOC gives you flexibility in borrowing and repaying, unlike a traditional mortgage. Lower interest rate. If the HELOC's interest rate is lower than your mortgage rate, you save money. Risks and considerations. Variable interest rate. HELOCs typically have variable interest rates, meaning your payments could increase if interest rates rise. Discipline required. This strategy requires strict financial discipline. Failing to pay off the HELOC quickly can lead to increased debt. Financial stability. Ensure you have a stable financial situation before committing to this strategy, as it involves managing multiple debts. Potential for increased debt. If you don't pay off the HELOC and continue borrowing from it, you could end up with more debt than you started with. Conclusion. Using a HELOC to pay off your mortgage faster can be a powerful tool when used wisely. By strategically leveraging the lower interest rates of a HELOC to make larger payments toward your mortgage principal, you can significantly reduce your mortgage term and save on interest costs. However, it's crucial to understand the risks and maintain financial discipline throughout the process. Consulting with a financial advisor before embarking on this strategy is recommended to ensure it aligns with your overall financial goals.